So now we're going to look at the NPV decision rule, and the net present value, that's what it stands for, solves or provides a solution for some of the problems we noted earlier, namely that we had no real way of weighting the time of the cash inflow. So cash inflows in year 5 weren't being, were less valuable to us than cash inflows in year 1. We needed some way of measuring that, and also risk. We wanted some notion as to the role of risk. So the decision rule for net present value, we've not looked at how it's calculated, but we will do in a second. If it's positive, then it should be accepted. If negative, it should be rejected. Competing projects have positive net present values, so if there's any competition, the one with the highest net present value wins. Right, well, now I was talking about the problem of cash flows further into the future being worth less. So this is the value of £1 as it goes into the future. Its value falls, so that £1 in 9 years' time is worth about 10 pence to us. £1 now is worth £1. So let's have a look at £1 in 1 year's time is worth 80 pence, because 80 pence times 1 plus the interest rate, let's go back here, the present value of £1 receivable at various times in the future, assuming an annual financing cost of 25%. So 25% is our financing cost, as it rightly says. It's our cost of time and risk, so it's the earning power that we want from our investment, and it's 25% per year. So every year we want it to earn, the project to earn 25%, which is a very high figure, but we're doing it really for illustrative purposes. So now we're saying that £1 in 1 year's time, its equivalent value now is 80 pence. So we can work that out as it shows there. Let's have a look at our calculator. So we've got 0.8 times 1.25 equals 1. So as it says there, if I invest 80 pence for 1 year, I get £1 at the end. So £1 in 1 year's time is worth 80 pence now. So the interest rate is the way in which we can move money around in time. If I said to someone, I can pay you £1 in 1 year's time, how much will you give me now? The person investing wants a 25% return. He would say, I will give you 80 pence now, and you repay that by paying me £1 in 1 year's time. So that would be a 25% return. So for 2 years we do exactly the same, only it's 25% per year, as I said, so it's turns out that it's 64 pence, so we can check that. So 0.64 times 1.25 times 1.25 equals 1. So if we said, well, there's £1 in 2 years' time, how much will you give me now? And you wanted a 25% return, then you would offer 64 pence now. And so it goes on. So for 51 pence is the present value of £1 in 3 years' time. And as we were saying, as we were saying, as we go into the future, so the present value of £1 falls and falls. Well, we weren't talking about £1, but we were talking in our projects about large amounts, say 200,000 in year 4, so we could multiply our 200,000 in year 4 by the discount rate, whatever it is for year 4. Well, we've not got year 4s, we've got years 3, so let's do year 3. So let's go back. Year 3, that is about I don't know, 150,000 for that project. So for year 3, we would multiply our 150,000 by 0.51 to get its value now. And so we can take all our future cash flows and sweep them back to the present, right? So that we've got its equivalent value now. And then we take off the investment. If we go back, remember the original investment, I've lost it here. We can then take off the original investment to get our net present value. So the first thing we do is we value everything at year 0, the present, and then we subtract our outlay from our revenues. So that's the process of net present value. Oh, there we have it. So we can sweep it all back to year 0 and then deduct 200 because that's a year 0 outlay, and 100 there and 500 there. So why is net present value better than the payback period? Well, the timing of the cash flows is one thing. We take account of that with net present value, less so with payback period. We take into account all the relevant cash flows and we can show that it does maximize the value of the business. Should just point out that these are net cash flows here, right? They're the inflows less the outflows, the red inflows figure. So it really achieves what payback period fails to do. So here we have an example of a net present value calculation. In this one we've got a discount factor of 15%. That's our interest rate, our cost of time, and these are calculated so as this is the present value of £1 in 6 years time and 1 year's time, 2 years, 3 years, and so on. So we can just check that. So 87 pence, so 0.87 times 1.15 equals £1, more or less. So that's 87 pence, then in 2 years time 75.6, 3 years 65, and so it goes on reducing the further you look into the future. And then we multiply that by our £30,000 cash flow times 87 pence, so that gives us the present value of this cash flow at the end of year 1. At the end of year 2, £1 is worth now, its present value is 75.6 pence. End of year 3, £1 at the end of year 3 is worth 65.8 pence now. And so we multiply these cash flows in the future by their present value. This one is 49.7 pence in the pound. So the present value is 14.91. So we've now managed to take all these future cash flows and sweep them back to their present value, the T0 value, the value now. And from that we deduct the investment that we're being asked to make now. And that we can now add these all up because they're at the same point in time, and that gives us a net present value of minus 23.49. So it's negative, so on that basis we should not invest in this project. So it is a reasonably simple calculation. You just take the cash flows, multiply them by their present value factor, and then that gives you their value at T0. Then just add them all up, and that is our net present value. Now we've taken the interest rate as being 15% in the previous example and 25% in the one before, and we've not really said much about the interest rate, but clearly it does reflect time in the fact that the further into the future the more interest you want. It's an interest rate per year. So we've said that the higher the interest rate, the higher the return you're asking for. Why are you asking for a higher return? Well, there are three main factors. One is something called time preference, which is just reward for lending. Then we have inflation. That's going to be a factor that you'll want to have compensated. And then risk. So the normal analysis of an interest rate is time preference and inflation and risk. So, but we needn't worry about that. We're not going to put that up on a slide or anything, but we just make that note in passing. So, strictly speaking, the net present value is fine. It works nicely, but one of the problems with it is that it produces a number, like as we were saying, negative 23,000, and that's not really a very comparable figure to use in calculations. So we want something that's a little more portable, and one way is simply to work out the interest rate, in other words vary this figure so that this figure is 0. So it kind of measures the maximum interest rate we can charge without the project having a negative net present value. So the maximum we can charge is when that goes to 0. So here's some calculations based on the example we've been looking at. You can see at 15% it was 23.5 was our net present value. It was negative. If we lower the return, we don't ask for as much, then the present values are a little bit higher, as you can see, and our net present value falls to 11. And then if we drop it down to 10%, it's very nearly 0. 9%, it's positive. So we can say at about 9.5% it's going to be 0 between these two figures. So 9.5% would be the internal rate of return. So in business terms you can say to a manager the project will earn 9.5%. And normally you can use that as a selection criteria, so you'd prefer a project with a 10% return and so on. However, it's not perfect, and there are some examples where it can give the wrong answer. Okay, so the IRR decision rule: project must meet a minimum internal rate of return requirement, and it calls it the opportunity cost of finance. I think that's a little bit unnecessary, frankly. It is just um, the opportunity cost is the cost of raising the money, and it's going to be earning more than the cost of borrowing. That's a little bit of an awkward thing to say, but we'll take it. In later studies, you'll qualify that. In competing projects, um, if they exceed the minimum IRR requirement, the one with the highest IRR is selected. That doesn't always give the best decision, but in most circumstances it will, so it's kind of good enough. The relationship between net present value and IRR, well, is as we saw on our table of figures. As we increase the interest rate, so the net present value falls. But as we were doing, as we decrease the interest rate, so the net present value rises. We had to do that because our example, if you remember, was negative. So we decreased the interest rate until it got to zero, and that was the internal rate of return point. So it's just going back to this. We decreased the interest rate until the net present value became zero, which was at about 9.5%. So that's the relationship between the two. Problems with IRRs, we've been saying, doesn't quite link with wealth maximization. We'll just take that as read. It ignores the scale of the investment. So in theory, an investment in pennies could produce a very high IRR, but you wouldn't have a large company interested in that, because it's only in pennies and not pounds. So the scale obviously matters, and in practical terms, businessmen would be aware of that. And it has difficulty with unconventional cash flows. That is where there are significant negative cash flows in the future. That can cause problems. But so long as the cash flows are all positive in the future, then there's no difficulty. Okay, so that gets us to looking at NPV and IRR, and on the next slide, which I briefly flicked over to, we're going to have a look at some problems with net present value that are not in your textbook, but nevertheless I think it's worth talking about them so that you can have you can put it into focus. In the early 1980s, the academic world began to have second thoughts about net present value and realized that in a business context it perhaps wasn't the complete answer. So what I want to do on this slide is to explain why that is the case. First of all, we're going to think of a project as producing cash flows far into the future. So we're not going to worry about the end of the project, and a lot of projects are like that. Businessmen say it's going to earn so much per year and don't really think of when the project is going to end. Shares can be looked at as projects, they're investments, and you don't think of the end of a company. So we're not going to worry about the length of time it's going to carry on. And these red dots here are on a time price space, and they represent the net present value of a project. And the net present value of the project is going to be the discounted value of its future value. So the value of a project can go up or it can go down, and it can go down and down and down, or it can go down and up, down and up. So as we go through this lattice, as it's called, we can take different paths, and since we don't know what's going to happen in the future, we can say, well, this is our present valuation, this is the net present value, and we don't know if the value of the project is going to go up or down. It depends what happens to the cash flows. So we say there's a 50% chance of the value of the project going up, and there's a 50% chance of it going down, and so on. So we get to this point, again, 50% chance of it going up and a 50% chance of it going down. So if we think of buying a share as an investment in a project of sorts, this could be the movement of a share price. But all projects have value and can be sold off, so they all have a price, as it were. The net present value is the current price. So that price can go up or it can go down. So these are price pathways through time. So using this binomial lattice, as it's called, we can ask some questions. One obvious question is, why don't we delay our investment? So we could have a rule that says, well, what about if we wait? We wait till a year's time, and in a year's time, if the project goes, if conditions are good, so that we think we've got to this point, then we'll invest. If conditions are bad, then we won't invest. So the good scenario would look like this. Okay, we would get to this point and we wouldn't be facing all these possibilities. So this is a rather more attractive way of looking at the future. So why not wait? Well, it turns out that we can do calculations that show that sometimes it's beneficial to wait and other times it isn't. But what we can say is that net present value assumes immediate investment. There's no sense, we're not doing a calculation to see if it's better to wait. So we can say that immediate investment, and we're not considering waiting. Now, there's one other major consideration that isn't taken into account, and that is, what about follow-on contingent decisions? In other words, if the value of the project goes up, say, to these levels, we can say if the value of the project goes above the green line, it's very successful, then we might want to expand in some way, or take over another company in the same market. So there are all sorts of business opportunities that we might want to consider if the value of the project reaches this green line and goes above it. So that's called an option, and there's a great problem in valuing this option because its value, that possibility of taking over or expanding, would be a valuable option here. But if the price of the share had gone down, the price of the investment had gone down to here, the value of that option would be very low. So the value of the option changes every time the price changes, which causes a valuation problem. If we look at prices in continuous time, if we look at it in this time, then we can value it quite simply by rolling back the present value of the contingent decision. So we needn't worry about that, but that's just saying that there are valuation problems. But from a business perspective, it's pretty clear that our net present value is not including any follow-on contingent decisions. So that is a problem. And so those are the two limitations of net present value, and they're particularly important from a business perspective because obviously delaying is something that is always open to a business. It doesn't have to invest now, and taking decisions as part of a strategy, a sequence of decisions, is normal thinking in business, and we've just isolated the investment in a rather artificial way, and follow-on decisions contingent on the outcome of this project. Follow-on decisions are obviously important. So net present value is limited. It isn't the answer, and there is no definitive answer, but these are approximations. They do their best, but they have to be considered in the wider business context before coming to a decision. Okay, so some practical points relating to investment appraisal. First of all, we're talking about relevant costs. We've talked about relevant costs in an earlier lecture. And we also mentioned that we're talking about net flows. That's revenues minus our costs. So we've got that. Taxation, we've not talked about taxation. That is a cost like anything else. Cash flows, not profit flows, is a big thing with us academics, but clearly you've got to make sure that your sales, your revenue turns into cash. We've assumed all cash flows happen at the end of the year, which is a bit unrealistic, but it's probably good enough. Interest payments, there may be borrowing payments to make, and we've not included that. And just to catch all any other factors of turning an investment into a practical proposition. So it's a number of these practical issues to consider. So looking at the investment appraisal methods, the ones using interest rate, net present value and internal rate of return are called discount cash flow methods. When we use interest rates to value things in the present, we call an interest rate a discount rate, but they're the same thing, right? So interest rate is the same as a discount rate. And we looked at net present value, internal rate of return, non-discounted cash flow methods, accounting rate of return, and payback. Those were the two ones that didn't use interest rates. So looking at practice, there have been many surveys of practice. Businesses tend to use more than one method, that's true. NPV and IRR become increasingly popular. I don't know why. I suspect partly because textbooks advocate them so strongly, and businesses don't want to appear to be they need to appear to be pursuing best practice, and if a lawyer might take best practice as being conforming to a textbook. So perhaps that might be the motive, but we'll have a little look at a survey later on that questions this. Continued popularity of payback period and accounting rate of return methods. Yes, despite what textbooks say about it, they're still used a lot in practice. Larger businesses rely more heavily on NPV and IRR than smaller businesses. True, they use it or tick the box more often than smaller businesses. Again, there is this issue of whether they are just want to seem to be conforming to best practice. So that's a little bit of an issue there. This is a particular survey they've dug up. Oh, sorry, a working paper 2007. And as you can see there, it says IRR NPV is on this scale. So nearly always payback period. See, Germany is kind of nearly as popular. Same in Japan. Same in UK and even in the United States. So that bears out our previous comments. As I was saying, there have been many surveys of practice, and they do produce varying results, and it's not entirely clear how much NPV is used, and especially amongst those who realise that it does not include the kind of strategic series of decisions that businesses are obviously keen on. I've got a little paper here. It is old, actually. It's 98, so it's 9 years older than the survey we were looking at, but it looks at a particular context, and it's looking at strategic investment decisions taken by 71 motor component manufacturers in 4 countries. So that kind of makes it interesting from a business perspective, because it looks at this concept of a strategic decision, and we are interested in the important decisions. So if we cut straight to the table, we have here they interviewed these companies, so it wasn't just ticking a box. They asked the managers. So the percent using DCF in any sense at all, 100% in the USA said they did use DCF on some investments. However, only 54% in the UK. So there were 46% who said no, we never used DCF at all. Only 28% in Germany used DCF on any investment at all, and only 18% in Japan. So a very different picture here. And then SIDs are strategic investment decisions. The percent used at all on strategic investment decisions, well, in the US on 1 or 2 they had maybe used DCF. 93% said they'd of the 11, in other words 10 out of the 11 said that they occasionally used DCF on a strategic decision. 35% in the UK, 28 and 8, only 8 in Japan. And then strategic, on a key strategic investment decision, 50, only half in the USA said they used it on a key decision, 12% in the UK, 16% in Germany, and 0 in Japan. They didn't use DCF for key strategic decisions. And then if we look at the payback is more popular on the key decisions. So that does rather paint a rather different picture. It then talks about return on capital employed, which we've not talked about, so we won't bother with that. The average internal rate of return as a target, 20, 23%, 14%, and didn't use it at all in Japan. And payback period, 4 years, 3 years, quite a short payback period. Right, so those were really rather short. So timing is important, and perhaps timing is important because if it didn't pay back in that period of time, then maybe it would be better to delay the payment. So, there are these further considerations that we saw that net present value didn't include. So an interesting set of results, and it shows you that you must always be skeptical about surveys and what they say, and don't treat them as absolute fact. Surveys tend to produce differing responses depending on the type of question. This one is rather more subtle because although it appears that they do use DCF on investments, when they started to drill down and ask about the important investments, then the use of DCF declined very rapidly. Okay, so on that note, we will conclude.